Welcome back, you legends. I'm Dr. Khan. Let's get right into this weekend market update video. We are now days away from the first Fed rate cut in this economic cycle. Next Wednesday, September 18th, 2:30 p.m. we are expecting the Fed press conference. 2 p.m. we expect the Fed to announce its interest rate cut decision of 25 basis points. It's going to be the first cut in a very long while in this entire economic expansion cycle that began in 2020. What does that mean? How to trade it? What is that going to mean in terms of timing the next major economic recession, as well as trading the rate cut in the next several months? Are we going to get that growth scare kind of rally, or are we going to get the feared recession finally materializing? The inverted yield curve is normalizing, and that is signaling a major shift that's coming next year. So let's get right into it. S&P, NASDAQ, and the Russell 2000 all closed in the green Friday, led by that breadth thrust that I discussed in the last video. And so far, the rally in the Russell 2000 and the broader market is playing out as expected. As breadth expands, the number of stocks in the overall stock market that are in the green are now expanding. More stocks closed above the 50-day versus below the 50-day Friday. We have vastly more new highs versus new lows, a ratio of more than 10-1 new highs to new lows Friday. More advancing stocks versus declining. More stocks trading above the 200-day versus below. This is that classic breadth kind of thrust where we see the S&P and the NASDAQ take a bit of a step back and allow the broader market to rally. Now let's take a look at the stock market map. Clearly Friday was that big breadth rotation. You see money stagnating, flowing out of big cap tech, most big cap tech, Apple, Meta, Amazon, Tesla, and Nvidia basically flat. And then we have the broader market in the green, led by the Russell, as we've just seen. Let's take a look at the different sectors. Leading Friday were basic materials, energy, cyclicals, technology, financials, a very broad set of sectors advancing, and the laggards were defensives and healthcare. This tells us that Friday was a risk on trade, meaning big money is rotating out of defensive, bearish sectors and into more bullish, offensive, riskier sectors. Taking a look at the daily chart for the S&P 500, we are still trading within this long-term uptrend. We're now outside of this near-term, short-term correction downtrend. We had a couple of these. Seasonality in September and in October tends to be bearish. However, we do have the rate cut coming up this week, and this is now giving the market some legs. The weekly expected move for next week for the S&P 500 is $9 in either direction. This gives us an upper expected move of 571 and a lower expected move of 553. As you can clearly see, market volatility is contracting because the expected range is shrinking. It is only $9, whereas last week the market moved by more than twice that much, $23 bottom to top last week. This week, we are now expecting about half of that move. Mark these levels on your chart, and let's jump into the last video thumbnail that I took, and it was this: market momentum improving. We had this correction ending. We had a breakout above this resistance line, perfect back test, double bottom with a bullish gap fill that we were looking for at support. This was a very important level. As a result, we had a very strong breakout. Now, to be fair, I did expect after the breakout that we could get either a consolidation or a pullback back to this key level of support at 549. We did not get any meaningful pullback. Instead, we had a small consolidation and we continued higher to my expected target, which was back to the top of this prior range. So pullback more muted, upside target still met, still looking bullish. And the rally, the last couple of trading sessions, Friday and Thursday, was actually led Small caps, we can clearly see this. This is the Russell 2000. Look at these big moves getting bigger and bigger as breadth expands. If I add the S&P 500 on this chart, you can clearly tell that the S&P 500 had its big breakout on Wednesday, and the Russell had a smaller breakout Wednesday, forming this bullish hammer candle. And then as breadth expanded, which is what I said to look for in the last video, a higher high, something that looks like this, just a small little pullback in the Russell, maybe back to the closing price of yesterday. The Russell does something like that, then I expect breadth to improve, and I do have a trade idea to trade something like this, a rotational breadth kind of thrust. And generally speaking, the way to kind of trade this kind of move, if you're expecting a breadth thrust, is to rotate out of the S&P and the NASDAQ and into the Russell. And we got it. We had the Russell leading the S&P with larger and larger candles, as the S&P actually making smaller and smaller gains. So a very clear breakout in the broader sectors, and then a smaller rotation out of big cap tech and the S&P and into small caps and the Russell 2000. Remember, the Russell and small caps are the #1 beneficiary from lower rates. So rate cuts affect small caps the most. They give them the biggest boost compared to any other part of the market. So with the expected rate cut coming, what can we actually now expect in the next, let's say, 12 months? Typically, when we reach peak rates and then begin to cut as the yield curve exits inversion and begins to normalize, we tend to see serious recessions follow, with an average of a 30% decline after each one of these examples. The key is going to be timing the exact top, because that's very tricky. For example, the top in 2019, as the Fed began to cut rates, did not come until about 6 months later in 2007, going into the 2008 recession. The rate cut basically coincided with the market top in 2000. The market top preceded the rate cut by about 6 months. So timing this is going to be very tricky. And if I take a look at the last 4 major rate cutting cycles, 1995, the market actually rallied by 20%. I will completely exclude this from the analysis, because in the 1995 rate easing cycle, there was no yield curve inversion. There was no expectation of a recession because the yield curve did not invert, no matter what anybody else tells you. 2001, 2000, we did have a yield curve inversion. The market ended up seeing a 10% decline in the next 12 months from peak prices to absolutely bottom prices. We actually saw the NASDAQ lose 80% during that decline. In 2007, broader markets saw a declines by 60%. However, 12 months later, so after the decline and a bit of a recovery, the market was only down about 20% from the rate cut. 2019, 12 months later, the market was still up. It had that V-shaped recovery after the 2020 pandemic. Here it is. This is July of 2019. This was the first rate cut. We had a bit of volatility. Then we had a big rally, and then the recession came, and it was accelerated because of the pandemic on top of it. But we had that V-shaped recovery. And as a result, since that rate cut came in, the market had actually pretty much recovered and saw some upside from that point on by the time that 12 months have passed. But in the interim between then, the market did see a 30% drop. So generally speaking, a rate cuts usually mean in a recessionary kind of theme, when we have an inverted yield curve, when economic growth is in question, we tend to get a more kind of negative reaction. 2019 was muted because of the significant rate cuts that were put in place in reaction to the pandemic. So that was a bit of an exception. But even then, we had a 30% decline from the peak. 2007, we had a 60+ decline from the peak. 2000 to 2002, we had about a 60% decline in the S&P, more than 80% in the NASDAQ 100. Let's take a look at the continuous jobless claims kind of chart. We need to see jobless claims rising consistently month after month for any kind of recession to come in. Still very much flat, even though we had that scare a couple of months ago or actually last month in August, continuous jobless claims still very much flat. However, this could be due to the fact that we've actually have gotten multiple revisions to the downside. It's clearly the government is cooking the numbers because it's even election year. And that means after the election rolls in and the market rallies, I think early 2025, we're going to get the reality that yes, we are in a recession. However, not likely to be as bad as 2008, not bad as 2000, although fairly bad. We're talking about 20% to 30% declines, probably 20% for the S&P, 30+% for the NASDAQ. So we're talking about some serious declines and a recession, not something that you want to be ignoring, something you want to be paying attention to, positioning yourself properly as we navigate that economic reality. And if you're looking to navigate that economic reality with me, check out the Money Time Machine Patreon group, become a member of the Money Time Machine Discord trading community. It's $30 a month if you go for the annual membership. It's $55 a month if you go for the monthly membership. I don't generally recommend the monthly membership. It is there if you want to try the community, see if it's a good fit for you. If it is, what most folks do and what I actually recommend is that if you like it, switch from the monthly membership to the annual membership. The reason I don't like the monthly membership is because some months in the year are very slow. Some months are very active. So a snapshot of 1 month, I don't think is enough. You cannot effectively see market cycles, different stages in a single month. It's just too short. So that's what I recommend. And if you do choose to sign up, I want to thank you and say to you, this is the best possible way to support my work and my channel. And it's the only way to keep track of all of what I do, all of my work, all of my analysis and trades in real time. I have to say though, if you're thinking about signing up for the monthly membership, I would recommend holding off because I'm going on a vacation between the 20th of September and the end of the month after the Fed rate cut. I've planned this months in advance, so I just don't want you legends to sign up and then have to sit there for 1 week where we don't have a lot of activity in the Discord community because I'm away. So another reason why I actually think the annual membership is simply much better all around. Also, make sure to go and subscribe to my second YouTube channel. Go to my YouTube page, click on that link. It'll take you to my second YouTube channel called Money Time Machine Legends. Everything money related and not technical analysis related is going to go on this second YouTube channel. This means short documentaries, investing stuff, some more fun stuff, lighthearted stuff, YouTube shorts. This is what I would classify as the fun channel. The Money Time Machine Legends channel is the fun channel, and the Money Time Machine OG channel is for technical analysis and reading the market. Speaking of fun, something I did not expect to see, never seen these below 99 cents, below $1. This is kind of that anecdotal type of evidence that is actually very informative and kind of funny. Job openings revisions though, not so much fun, not so much fun. Very naughty government doing naughty things as usual. Just be aware of that. I think market dynamics are kind of skewed this year because it is an election year. We just have to keep that in mind. Now, in a growth scare scenario where we have actually a soft landing, what tends to happen is we get a bit of a sell-off after the rate cut comes in. Then the market basically stabilizes and we get a 12-month rally. This is true in the cases of normalization when there's no growth scare and the Fed begins to basically cut rates just to maintain the economic expansion. But in cases of recession, the rate cut tends to signal the beginning of a lot of trouble, even 2 years out. Generally, the market has not recovered 2 years out. Can you imagine that? If I actually take a look at the S&P 500 weekly chart, we can clearly see that was the case in 2008. The Fed begins to cut rates right about here, and the market continues to decline, forms a bottom about a year later. But from the peak, market take a look at this, 270 weeks before it completely recovers. It takes the market from 2009 all the way to 2012 to actually completely recover from that deep recession. In 2000, pretty much the same kind of picture here, although the market did top first, then the Fed rate cut came in 2001, market continued to decline, and we did not recover these prior highs for, let's see, 2,500 days, basically 7 years before the market clawed back those gains. And then we had another recession, and pretty much the same thing again from 2007 all the way to 2012, about 5 years before the market completely recovered. So these are pretty serious. In 1989, this was the last time before the Great Recession and the dot-com bust that we had a recession and a rate cut, and this was a much milder recession. In this case, from the peak to the bottom, we had about a 20% decline, and the market recovered. It took the market less than a year to complete a full recovery. 1989, the Fed cuts somewhere in here, then we get the recession, then we get kind of a V-shaped, very quick recovery in 1 year, and the market is back on track. So what are my personal expectations? I'm not expecting a 2008 kind of crash and very prolonged and slow recovery. I'm not expecting a 2001 to 2003 very slow decline, very slow recovery. What I actually think is more likely is that we will get something that is closer to the 1989 kind of quick drop, quick recovery, and market makes it back on track and recovers. I would say that's the case for a combination of reasons. Number one, a weaker dollar. Weaker dollar means a stronger global economic activity. When the dollar weakens, the global purchasing power of other economies go up, and that's positive for the global economy, not so much for the US. If you are holding dollars, if you're holding gold, stocks, equities, other stuff, you will be shielded from the weakness in the dollar. So that's number one. Number two, we just came out of a pandemic, right? A 2020 pandemic. What tends to happen after pandemics, we tend to get a huge outflux. People exiting the jobs market without ever coming back. Folks retiring early, folks simply completely exiting the jobs market, mothers wanting to stay with their children, not wanting to go back into the job market. A lot of folks exiting the jobs market. When that happens, two things tend to follow. Number one, inflation, because we have fewer workers. That means higher wages, more demand for workers. And number two, what also tends to happen is that the job market tends to stay tighter for longer. This means the jobs market is less prone to recessionary kind of layoffs and weakness. And if you only look back at the last couple of recessions, you will never come to these two conclusions. You'll have to take a look at hundreds of years of data. And I went back, even back to the Black Plague 1,000 years ago, a couple of really big Black Plague pandemics. And I looked at how that affected the economy. And we always had these two things: inflation, because we have fewer workers, and economic prosperity for the lower and middle class always went up for the working class because there's more demand for workers. I also went back and looked at the data after the Spanish flu, and what we had was the roaring 20s after the Spanish flu. And again, huge economic boom, very strong inflation, demand for workers, and then all of that came back to crash down several years later. I still think we are in the middle of this kind of major shift in the jobs market until AI begins to take more middle and working class jobs. With that being said, let's focus more on the medium term, near term. What happens next? If we take a look at the growth kind of scare and recession kind of playbooks, I don't think we get anything like this or this. I think we actually get something more in the middle. I do think the market will continue to rally until the end of this year, but we have to keep in mind seasonality. So what I actually think is going to happen is we'll get a kind of Fed cut rally before the cut and potentially 1 or 2 days after the cut. And that's it. I think the market will have a sell the news kind of reaction after the rate cut gets priced in, after the small caps complete their kind of breakout. I think we go back to trading seasonality, bearish seasonality into October, and then I think we get a big rally in November, December. So very near term, I think the market will rally into the Fed cut this week, potentially top after the cut, a couple of days maybe after the cut, and then we go back to trading seasonality. That means more weakness coming in at the end of September and then throughout October, and then we get that final rally toward the end of the year. And after that, I think we follow more of that 1989 kind of playbook. I think the market will see a recession, not as deep as most folks think, but I do think we'll get a recession, sell-off, market repricing, and then as the yield curve continues to normalize, we get a bottom sometime late next year, I believe, and then we continue the rally and the economic expansion for several more years, probably into 2028 or so. So now let's focus on the near term. Expected move $9 in either direction. We're back at the prior highs. This is a key level of resistance. Does the market exceed it after the rate cut? Possible. But I think we have to keep in mind seasonality. So even if we exceed these prior highs after the cut next week, I would still expect more weakness to come back into October and then a rally in November and December. So far, market looks positive. We're now trading above the 5-day, 10-day, and 50-day moving averages. All positive signs. The rally is slowing down slightly as breadth expands and money flows out of the big cap tech and S&P 500 holdings and into small caps like the Russell 2000 in preparation of that rate cut. Now we've had 5 consecutive green daily closures on the S&P 500. We closed higher Monday, Tuesday, Wednesday, Thursday, Friday. Every single day was positive with the very brief exception of that double bottom that formed on Wednesday. I was hoping for a pullback and then a continuation higher to allow more bulls to reposition. That did not happen. We had a very brief kind of consolidation, then we continued higher for 2 more days. If we take a look at the NASDAQ 100, we have officially broken above this key resistance line. This tells me that the NASDAQ is very likely to at least go back to this prior resistance line. This means a rally back to $483 or so, back to this prior high, 485 in fact. So this is now the key resistance for next week, in my opinion. Can we get a pullback early in the week and then continue higher? That's also possible. It's going to be exceptionally difficult to time these pullbacks. I would say even impossible to time these pullbacks. You cannot time them, but you can trade them. And if you find a pullback that, let's say, goes back to tag this resistance line, backtest would be positive. A backtest can happen as low as 464 Monday or even lower Tuesday to 463 by Tuesday. If we get that, I think that's going to be still a buy. If we don't get that, if we continue to get a consolidation, then I expect a rally on the FOMC decision to cut rates and potentially a rally the following day, and then probably the top for September comes in. Dow Jones still looks very positive, very small pullback relative to the S&P and the NASDAQ. Pretty much back to all-time highs for the Dow Jones, likely to exceed this prior high this upcoming week. If I take a look at the 1-hour chart, again, very similar look to what I had in my last thumbnail. I did expect that pullback. We did not get as deep of a pullback as I wanted, only a consolidation, and then we continued higher. So what to look for next in terms of a healthy pullback? Well, if we rally back up to the top of the range, then the pullback target will be shrunk down to simply the bottom of this prior range, right? So if we rally to the top, just look for a pullback back to the bottom of the range. This means potentially a pullback from 563, 564 back down to, let's see, 555. If that does indeed happen before the Fed rate cut, then we can expect another rally and a breakout, probably exceeding these prior highs, potentially just matching them and stopping there. We don't know. Trading the rate cut is going to be very tricky. I still think it's going to be a sell kind of the news event. The stochastic and RSI are getting overbought, however, not overbought enough to look for a top yet. Stochastic maybe, RSI not quite there yet. If I take a look at the NASDAQ 100 again, RSI not overbought enough. We were not back at these prior highs. I do expect the market will come back to these prior highs. That means 485 for the NASDAQ 100. In terms of support, now support is at 465. So that means if we get a pullback early in the week, 465 is going to be support and we'll get a bounce off 465. If we don't get any pullback, the market will likely just continue to rally to this target, and then we get the sell the news event, maybe a day or two later after the Fed rate cut. S&P 500 futures got a bit of a pullback. So the futures did pull back, not the S&P 500 ETFs, however. So we got a bit of a pullback. We rallied now. We're not back yet at the prior top of the range. I still expect more upside likely coming. If we get a pullback in the futures, look at the bottom of the range to act as support. That means 5,580 as support and resistance at 5,670. NASDAQ 100 futures closed above this key resistance level. This means we rally back up to this prior resistance level. For the NASDAQ 100, this means a rally back to 20,000. For support, this prior resistance line will now act as support. This means look for support at 19,200. This key level, look at this. Previous support here and now support from the trend line as well as the moving averages. So 19,200 is support. 20,000 plus is the upside target for the NASDAQ 100 futures. The VIX has broken down, is continuing to go down. The VIX still has more room to decline to go back to the bottom of the range. This means the market still has more room to actually continue higher. Russell 2000 still looks positive, has this double bottom kind of look, and we're now forming this consolidation pattern with a potential breakout coming up very soon. Very key breakout, and if it succeeds, I think the Russell 2000 will end the year at 245 plus, a rally all the way to the top of this channel, very likely by the end of the year. Between now and then, expect bearish seasonality in September and October to continue to play a role, so perhaps expect the Russell to rally back to these prior highs at 230 or so, and then consolidate, pull back again in October, and then rally to 250 or thereabouts by the end of the year. NASDAQ 100 relative to the S&P 500 up top, and this is the S&P 500 in blue and black. At the bottom, in the light blue and the orange, is the NASDAQ 100. We have the double bottom with a bullish divergence. On the ratio chart, this means the NASDAQ 100 in tech should lead the market higher in the next week as we get that Fed cut rally. XLY relative to XLP, this is consumer discretionary relative to consumer staples. That is bullish sectors versus bearish sectors. And we did get a breakout. We're now back at this resistance. We will likely see this ratio chart break above this resistance and rally all the way back to this prior resistance level. This means Amazon, Tesla continuing to outperform the rest of the market and the S&P 500 in the next week or so. Smart money up top, S&P 500 down below. Smart money made a new high, S&P 500 likely to follow and make a new high, whether that happens next week and then we get that bearish seasonality playing out in October, or maybe we just go back to these prior highs and then stall with the Russell leading the market higher without the S&P 500 exceeding the highs. That's still possible. However, I do think a new high is more likely. Put to call ratio formed this double top kind of formation, declined significantly by Friday. The 5-day moving average needs to close below the 0.8 level to give us another buy signal. The MACD is also showing kind of a double top with another crossover coming soon. Once we get that, it will give us another bullish buying signal. Not there yet, getting closer. New York Stock Exchange Summation Index up top, about to get another bullish cross. The oscillator already turned green, very positive for the market still. The NASDAQ Composite Index likely to continue to rally. Looks like a very bullish double bottom with a higher low. Again, setting us up for a significant rally in the NASDAQ, likely going back to 485 by the end of next week. Breadth has improved. The percent of stocks in the S&P 500 trading above their 200-day moving average has continually improved. Wednesday, Thursday, and Friday above the 50-day moving average, slightly slowed down by Friday as that rotation continues out of big cap tech and the S&P and into small caps and the Russell 2000. Up top is TLT, long-term treasuries relative to the S&P 500. This is the imminent doom indicator. I track it because when we get a close above the 50-week moving average or the 10-month moving average, we tend to get a topping signal that coincides almost too perfectly with the actual top. Take a look at 2008. It called the top perfectly and we got a major kind of sell-off follow through. These dotted lines are when we got that same signal without the yield curve ever inverting. So these are not recessionary signals. They are bearish, but not recessionary. This is bearish and recessionary. And when both coincide, we get a big, huge kind of recessionary led bear market. I expect that to happen next year, although not as bearish as the 2008 bear market, in my opinion. Now, we do have some warning signs that I need to point out. I feel obligated to point out. Up top is the S&P. Below that is the NASDAQ 100. This is the NASDAQ. This is the S&P, okay? What I want to point out is that whenever we got a correction in the S&P and we got a breakout out of the correction, we always ended up making a new high, always ended up making a new high. The only exception was the breakout in August. We failed to make a new high. That's why I have a red circle. The NASDAQ 100, again, new high, failed to make a new high. Now, are we getting a complex kind of double bottom formation and we're now getting a new high? Very possible. I would say it is likely the case for the S&P 500, although the NASDAQ, I think we'll have to be more patient and wait for the NASDAQ to rally in November and December and then get the new high. You have to keep in mind seasonality is still a bearish for September and October, although tempered bullishly, slightly leaning more bullishly because of the Fed rate cut next week. So in summary, next week, the most important event in this economic cycle, we tend to get major market shakeouts after the first Fed rate cut in a recessionary theme. Without a recession, we tend to get a very strong economic boost when the Fed begins to cut rates. However, with recession on the horizon, we tend to get either a quick few months rally and then we get the sell-off, or we tend to top and then sell off. In 1989 is the example that I think will most closely mimic what happens in the next year. I think we do get a recession. We do get a recessionary led bear market in 2025. I don't think it's as bad as 2000 to 2003, that dot-com bust. I don't think it's as bad as 2008. I think the market does get maybe a 20 to 30% sell-off, but between now and then, I think the market still makes new highs, potentially as early as next week, and certainly more likely November, December, and then we get the top early next year, and then we get the recession, we get the sell-off, probably 20, 30%, we bottom, and then the economic expansion continues. I talked about this a lot. It has to do with pandemic related effects on the jobs market. It tends to lead to significant tightening in the jobs market that tends to last for years and years and years. And as the jobs market gets tighter and tighter, it tends to hold up stronger and stronger during recessions. It's not going to be like 2008, not going to be like the pandemic. Layoffs are coming, not as bad as most people think, however. And because of the weakness of the dollar, the economic reality on the global stage is going to be more positive than 2008 and 2000. This means tempered losses in the jobs market as well as stronger global economic activity will, in my opinion, mean that the recession that is coming next year is not going to be as bad as what we've actually been used to or seen in the last couple of decades. And I think we will more likely see something closer to the 1989 kind of recession, a brief, shallow, lasts about a year, 20 to 30% sell-off, and then a very strong economic expansion on the other side. Take a screenshot of this chart. It will help you track what happens next. Are we going to get a huge economic boom as the Fed begins to cut rates? Is the Fed too late? I do think the Fed is too late. Are we going to enter recession? I do believe we are going to enter recession. Is the recession going to be as bad as 2008 and 2000, where we had to wait 7 years in 2000 to recover new highs, 5 years after 2008 to recover new highs? No, I think we're going to see a 1-year recession, and I think the market will recover in 2026 and get a very strong multi-year bull market, healthy bull market following that. So what to watch next week? New York Empire State Manufacturing Index, 8:30 a.m. Monday morning tomorrow. Tuesday morning, retail sales. Wednesday, we're going to get building permits, Fed interest rate decision, and Fed press conference. So let's close this out with the fear and greed index. Let's take a look at the timeline. Back at 50, not quite as high as 60 as we've seen these prior tops come in at around 60. Market momentum improving, strength is improving, market breadth is now picking back up slightly, seeing this kind of small bounce here that is positive. Put to call ratio is definitely declining. I talked about this earlier in the video. This double top in the put to call ratio is positive. Market volatility has a double top kind of look. I want to see it back at the bottom of this range, probably coming next week. Safe haven demand declining, junk bond demand still very positive. Thank you for watching until the end. Slap that like button on your way out. It helps me tremendously. If you watched till the end and you did not enjoy the video, I still thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you all in the next one. Bye-bye.
Oh, wow.